So what happens if you have a low score? How much does a low credit score really affect your interest rate? Well, in this discussion, what I'm going to do is I'm going to be talking about that relative to the Fannie Mae FICO and loan to value grid. Fannie Mae and Freddie Mac does the same thing. Both agencies publish a grid for determining the pricing on a mortgage based on your FICO score and your loan to value. In the Fannie Mae chart, there are a total of 9 tiers of what's called loan level price adjustments. Think of loan level price adjustments kind of similar to points. And so what happens is when you look at this grid, there are 9 tiers, with the highest being 780 or higher, and then the lowest being 620, because 620 is the minimum score for a Fannie Mae loan. Now, these tiers are split up in 20-point increments. So, of course, if you're over 680, if you're over 780, you're over 780. But that would be considered the top tier in terms of pricing. The second best tier is 760 to 779. The third best tier is 740 to 759. And the fourth, 720 to 739, and so forth. So again, 20-point increments, a total of 9 different tiers from the best to the worst. And what's interesting about when you look at the Fannie Mae FICO loan to value grid, the worst combination of score and loan to value is going to be in terms of what these loan level price adjustments are going to be charged. Sort of the worst spot in the grid is if you're in a loan to value between 75 and 90%. In other words, the loan level price adjustments for lower credit score are highest when you have a loan to value between 75, 01, and 90. So that means essentially less than 25% down, up to 10% down. That actually is where you're going to get hit hardest with these loan level price adjustments as you go down further in the credit score range, into the 600s and particularly into the low 600s. What's really interesting about the grid is when you look at these loan level price adjustments for credit score, they actually get better. In other words, the charges for low credit score are reduced once you hit 90% loan to value, or actually higher than 90% loan to value. It's actually pricing is better. The loan level adjustments that they charge you for your lower credit score are actually less than if you put 15 or 20% down. That seems kind of counterintuitive, right?